to another episode of the Commonwealth Homeownership Real Estate Investing Podcast. I'm Phil Wong. Joining me as always is Brad Price, and coming back is Kim Nguyen. Welcome back, Kim.
What is the latest and greatest in the mortgage world? Let's dive right into it.
The biggest news that comes through and is effective as of June 1st is that OSFI is actually changing the qualifying rules. So that's been a big shaker in my industry. There's a lot of people scrambling because as of June 1st, it's going to get a little bit harder to qualify for a mortgage. Again, this is only applicable if you are buying a home with 20% or more down payment. So we call it a conventional mortgage. So a mortgage that does not require the insurer, backing us up. That's who's going to be affected. If you're getting a high ratio mortgage, the qualifying rule is you need to have enough income to qualify for a mortgage at an interest rate of 4.79, which is Canada's benchmark, or 2% plus your actual interest rate, whichever is greater. That's what you guys would qualify for. But with this new rule, though, those who are looking to buy a home with 20% down payment or more will need to either qualify at a rate of 5.25% or your actual interest rate plus 2%, whichever is higher. So in today's rate economy, it would be 5.25%. A lot of the banks actually rallied and asked for a change. There's a lot of people that went to the government and said, because the markets are so hot right now, we need to do something to cool down the markets. And the government of Canada is also afraid of affordability, right? That's another key aspect too, because as the house prices keep creeping up and up, like what will happen if rates do rise, right? Will people have to foreclose now? That's kind of what they're concerned about. They just don't want another housing crisis to happen. And I have a feeling that this is step one, and there may be more steps. If this doesn't help to cool the market, they will implement other things quick. I think interest rates are actually going to stay the same. I don't see it going up because I feel like with the way that the market is acting right now, once this rule changes, it will affect some people, not all, and that will cut off a few clients.
Are we on an even keel? Is that why you're quietly confident that rates are going to stay where they are for the time being?
Stable, guys. It's really been stable. It hasn't really moved much. It's still sitting at around, today I checked, 0.96 give or take. So really what that in essence means is that the current rates that we see right now, the ranges for fixed rates anyways go anywhere as low as 1.54 to about 1.94, give or take. With the bond yields, it's being the same as how it's been for the past week or so. I don't really see any major changes, but we'll see after June 1st. But I have a feeling that just naturally, because we're in a busier spring market, busier summer market that's coming, these are the hottest times for real estate. And again, if lenders are smart, this is a time that they want to introduce these promos, introduce these really competitive interest rates, so that way, like I said, they're getting more clients, right? Clients that are buying go to them. They got to stay competitive. This is the time to make money for them. When you really break down the math, it's actually just about a 4% reduction in how much you actually qualify for. So it's not too much of a difference, but again, it could really be make or break, especially if you're in the more expensive markets like in Toronto and Vancouver. It would really affect you there. But here in Alberta, like a 4% reduction in your mortgage amount isn't that much, right? It's still something that's doable. Yeah, you can still find something that's kind of quite comparable.
You read a headline and it can play a bit of have a psychological effect. But when you actually break it down, if you look at it from a 4% perspective, that's only on a $400,000 house, it's only $16,000. So really, when you're out there looking for properties and you're taking that into consideration, it's not really a game changer. Whereas when you're in like another city, say Vancouver, Toronto, like you're talking in the tens of thousands of dollars, right? You're like your $1 million average house price, you're $40,000 straight off the bat.
And that could be, that's a lot of cuts, right? Maybe that's, now you're trimming down the square footage, or maybe now you're going to another neighborhood that isn't as nice. It's really going to impact the bigger markets. But in Alberta, I really don't see that slowing us down. Like, we're hotter than ever here. It's crazy out there in the market. Usually when you go into a bank and let's say you're buying a new build, right? Most lenders, a majority of them, will require an appraisal. And within an appraisal, the main things that they're looking for is that you're buying the home for what it's actually worth. And within the appraisal report, what they're looking at is recent sales in the area. Okay, so they're comparing it to resale homes on the market. That's how they come up with the appraised value. But the issue that we're running into is because of the huge increase in the homes, especially for new builds, there's no comparables out there to match it. There's just nothing that is of a comparable. So in essence, we're seeing appraisal values come back lower. And the detrimental thing to that is if your appraised value comes in lower, you have to come up with that difference, right? If your appraisal comes in 10K lower, well, that 10K has to come from you in addition to your existing down payment if you want to proceed with the home. So it is a common problem that we're seeing right now, just because, yeah, there's one builder in particular where I know that they've increased their price by 25,000 already within 1 month. Same lot and everything, 25 grand. And we just don't know like if it's going to go down anytime soon. I would hope so. Like I'd hope, the supplies come back, but it's really hard to say right now. Buying a new build, like my advice for clients going down that route is just be mindful that again, like if an appraisal is required, something to be mindful, right? It could be very difficult to get an appraisal.
I don't think you'll see the prices dropping immediately or anytime soon, because a lot of that material is pre-purchased in bulk by a lot of those big companies. So, what we're purchasing today at a store level, it has been pre-purchased 6, 9, 12 months ago. So when they're purchasing now, I mean, that's just going to carry on until, 12 months, 18 months down the road. The appraisal side of things, are all of the banks, are all lenders across the board in this day and age looking for appraisals, even on new build properties?
It is a more common thing that we're seeing now. So usually what happens is when we submit a deal with most lenders, they have like an automated valuation model. So that means that, you enter in the property details and it runs through their back end system to see if this value is good, right? They go through their database to see, okay, yeah, this value is good. But what we're seeing now is because the prices have gone up so high, it's not passing that automated system. And instead it's triggering an actual full appraisal. And that's where we get in trouble, right? If it passes the automated system, perfect, we're golden. But right now, because of the crazy increases, I'm finding it's more and more common to see an actual appraisal being triggered, unfortunately. If you're buying a resale home, there's going to be more comparables, again, like compared to builder deals. Because the one thing that you have to keep in mind is if you're working with like a large volume builder, they may have sold the exact same home on a different lot with the same price, right? That could be considered comparable. But if it wasn't listed on MLS, the appraiser cannot use it. So that's where we get in trouble because while your builder could come back and be like, well, you know what, this is the price of the home. Your next door neighbor is the exact same layout, just a different lot and stuff, and that's what we sold it for. Because the sale didn't happen on MLS and we can't use that as a comparable when doing the appraisal report, that's where it gets tricky. That's why when you're buying a resale home, when realtors list a home, that's what they're doing. They're doing market research on things that have sold on MLS, right? There's no off market listings, nothing like that. Everything is purely MLS listed.
Every time I purchase a home, I've always had an appraisal done. So what circumstance would a bank not ask for one?
Usually primary residence. So when you're buying a rental property, it's mandatory you need an appraisal. So it's very rare that a lender would let it pass without an appraisal. But the main thing is if you're buying a rental, appraisal is required, hands down, all the time. There's no exception to that. But when you're buying a primary residence, that's where it can go through the automated system. But again, like I said, it has to filter through that, and if it doesn't pass, then for sure we need an appraisal.
So we talked a little bit about if the appraisal is completed, but the value's not there on the appraisal because maybe there's not enough comps. What about situations where the appraisal comes back at more than what you're purchasing the property for? Does that affect the amount the bank will lend you or set you up with, or they just give you the mortgage that you've asked for?
Yeah, they usually just, if it's a purchase, then they just give you the mortgage that you've asked for. But if you're doing a refinance, that's when we can go back and then push it up to the 80% loan to value of the actual appraised amount.
Walk us through a standard pre-approval, a timeline, how long that would normally last, and how is that? Has it changed, or what's been happening in that side of things?
So one thing with this crazy market, a lot of clients are doing pre-approvals, of course, by their advice from their realtor, just simply because in a hot market like this, you cannot write an offer unless you're actually prepared. Because right now, if you're asking for such long, like condition of financing date or something, you'll lose the deal because the market is so hot. We're also seeing this trend here where a lot of clients are doing pre-approvals because they're under the assumption that if they do a pre-approval before June 1st, they will be grandfathered the regular rules. So to set the facts straight, many banks have actually come out and said that is not the case. Even if you have a pre-approval in place and we ran the numbers qualifying you on the 4.79% interest rate, if you find a home and you have an actual offer to purchase that's dated after June 1st, you're going to be requalified at the new rules. So it's something that most consumers should be well aware of, and this is also for those investors out there as well too, right? It works the exact same way. Like when you're stress testing your portfolios, you're probably using the 4.79 now, but again, if you're buying after June 1st, you need to use 5.25%.
How about the turnaround times here? So we talk a little bit about the if you going in unprepared and you're getting to that end of that period where you need to waive conditions for financing and go for an extension. And this is something that I've run into in the last week or so here. But I mean, you can lose a deal if you have to ask for an extension. So I mean, what are the typical turnaround times at the moment that you've been seeing?
Every lender is a little different, but the general consensus that we're seeing is pretty much almost like 3 to 5 business days. We even have a local credit union that we're working with that just sent an announcement saying they're 8 business days for review right now. And on top of that, there's some lenders that have even mentioned that if we have an offer to purchase, and let's say, it is May 25th or something like that. If we see the closing date is not 30 days past that date, so June 25th, we will not review it. We won't make it in time because again, it goes through this whole cycle, right? You got to do the underwriting for the few days, and then behind the scenes, you got to remember the lender's prepping the paperwork to send to your lawyer for the final signing. But again, of course, lawyers are also busy as well too. So have been lenders that have been very vocal. They say if your closing date is within 3 weeks, forget it. Don't send it to us. We're going to decline you. We won't give you any mortgages. Be mindful of that. And I've had even some cases, clients coming to me saying that they walked into their local branch, just saw like a financial advisor, and it took them 3 weeks to get an answer. They extended conditions 3 times. On the broker side, like we actively know what the lender turnaround times are because they have to send us that update, right? They have a commitment to us. But if you're working at like a local branch or something like that, there's millions of underwriters that work in wherever, and they're not obligated to give you turnaround time. But 3 weeks though, and that was from one of the major banks. 3 weeks.
So bottom line is do not try for a quick close in this environment.
No, not like I don't recommend it because then you got to remember you're shrinking your lender pool, right? There are still lenders that will service that. They'll be like, yeah, give it to me, no problem. But I know that I'm the only lender that will do this. So my rates aren't going to be great. They're going to be terrible.
If you're buying investment properties, you're limiting the number of properties that you are allowed to have. Like I think some lenders are limiting those lowest 3 properties. Anything beyond that, they won't let you purchase more. Has that changed given that the housing market has improved significantly across the country?
It has. They're more open to those exceptions. It's still considered an exception, but at least the door is open now. Now that we're seeing some stable growth, again, lenders are opening the doors up. They're allowing exceptions, but they're still on the side of, they're still kind of cautious just because, again, like it's not steady, right? It hasn't been that consistent yet. It's only been growing for the past 5 months or so. So I think like if this continues for the whole year, I think Alberta is going to be back into the lending game. Like more lenders are going to be more open towards Alberta.
Kim, where are we with refinances, increasing lines of credits? What's the process right now? Because I know just with the increased value, a lot of people have been coming back to try and access some of that equity in their properties. And especially one thing I have noticed is, investors outside of Alberta, where appreciation gain has been massive over the last few years, accessing equity to then invest in Alberta. So through that refinance process, obviously it's a good way to access some funds. But I mean, is that process changing? Are banks viewing it the same as they always did, or are appraisers being conservative?
You still have to go through the whole application process, and there's always still going to be an appraisal that is involved in that situation. But again, because of the increased movement, like more sales in the market, your appraised value is a little bit more favorable. And again, like I find that appraisers aren't being so conservative with that because they see how hot the market is. So I'm finding that appraised value is coming in at what we're seeing, or if not higher. But the only thing that is scary though is, clients that are looking to do some type of refinance plus improvements. So I've got a lot of clients who are like, you know what, market's picking up. Why don't I take out some equity and, develop my basement, build a home gym, or do whatever the case is. If you're looking for some type of improvement product with a mortgage, with a refinance, just be careful, because what we're seeing is, again, going back to the whole builder talk, the cost of lumber is going up. So cost of supplies and materials going up, cost of labor is going up. What we're seeing is that clients who want to, use the develop a basement as an example, clients who want to develop a basement, they're providing the quote to the lender saying, here's my quote. I want to develop my basement. Can you please fund this? Can I, get this portion mortgage? And what we're finding is when we're doing the appraisal to ensure that that value is there, if we do this basement development, are we going to add value to your home? We're finding that the two numbers are different, right? The cost of doing all the renovations is much higher than the actual value that it's actually going to build on your home. And when that happens, the lenders either won't proceed with it, or you have to reduce how much you can get in terms of improvement funds.
And are there specific items in a property that you should look at either renovating or not renovating as part of the purchase plus improvements?
Totally, yeah. So I find like the most bang for your buck, kitchens. I don't know what it is, but I find that adds a lot of value to a home. Kitchens, some bathroom upgrades, or just like simple things like replacing carpet to hardwood floor, right? That's been a big one. But the ones that you have to be really careful of is basement developments. While they are really, really good, but if you're doing something like a home gym, could be really, it's questionable, right? It's a little questionable because again, you're not adding like any rooms or anything. It's a gym, right? If it's going to be an open space as a gym, there's not much value to it. Another thing too, now that we're coming into the nicer weather months, landscaping, be careful with that, because I had a client here looking to add artificial turf, fake grass. That stuff is expensive, you guys, but did you know it doesn't really add that much value to your home whether you have fake grass or real grass? It really doesn't. The return is actually, it's not that high. And if you have that in your quote, again, the lenders won't lend dollar for dollar for that, right? It's just not, the improvement amount isn't there.
What's your opinion on A, legal basement suites, and B, garages?
That one there, legal basement suites, perfect example. That definitely increases the value. But the thing that you have to be careful of is the cost of labor and material now, right? Because before it was reasonable, pricing wasn't crazy, but now I feel like it's like the whole builder thing now, because everything's expensive. Supplies are expensive and labor. That top up on the lumber and also the top up on the labor, because everyone's busy now. If you find like a good tradesperson, they're going to charge you an arm and leg because they know you can't find anyone else. That small cost alone could cost you the whole improvement quote, right? It could cost you the whole appraisal because it's too high of a jump. Like we're seeing that side like really, really spike up. Garage is still good. So garage is still a very, very good improvement.
That's a great episode, Kim. Thank you. I mean, from what I've gathered so far, make sure you allow enough time for your closing to make sure the lenders get back to you and you don't have to extend. B, don't panic with the upcoming qualifying rate increase. It's a 4% drop in your purchase power, but hopefully you shouldn't need to depend on that 4% anyway. And C, be more mindful of your upcoming renovations. Because lumber prices are probably not going to be dropping for a little while. Well, thank you, Kim.
Thanks.
And
guys. Yeah.
And thanks for listening, everyone. Stay safe out there.